Ask any entrepreneur what the most challenging thing about starting a business is, and chances are they'll tell you the same thing: funding. Even for the biggest companies in the world right now, funding was the most important part of getting started. And contrary to popular belief, it doesn't really matter how big and exciting your idea is. If you don't have enough funds to launch and maintain your project, it's game over. However, there are a number of practical options available for entrepreneurs who are in need of funding, and since we understand that a successful start is one of the most challenging parts of the entrepreneurial journey, we have compiled a list of 7 of the most effective ways to raise capital for your startup business. Number 1, bootstrapping. Bootstrapping is described as a situation in which an entrepreneur founds and starts a business using personal finances or operating revenue. This is a situation in which you as the entrepreneur normally uses up saved money or money you have obtained from friends and family to start your business. Since bootstrapping only applies for small-scale enterprise, it may not provide enough investment for your company and may place unnecessary financial risk on your shoulders. An example of a company that started using the bootstrap method is GoPro, which eventually went public with a $3 billion valuation. The second option we are going to look at is crowdfunding. Now, crowdfunding is described as the practice of funding a business venture or idea by raising small amounts of money from a large number of people via the internet. Crowdfunding uses the easy access of a vast network of people through social media and crowdfunding websites to bring investors and entrepreneurs together. This method is beneficial as it creates public interest and is a great platform to market your business venture. The downside, however, is that there could be a lot of competition on crowdfunding websites if there are other people pitching similar ideas to yours. Examples of crowdfunding websites you could check out are Kickstarter and Indiegogo, which have helped crowdfund companies such as Oculus VR and M3D amongst so many others. Moving on to our third option, which is the oldest and most common option on the list, the good old bank loan. Even as new ways of raising capital emerge, traditional financing remains one of the most effective ways for small businesses to fund their operations. Banking institutions provide financial backing on loans to individuals who approach them with a solid and well-structured business plan. When applying for a commercial bank loan, there are a few requirements expected by the bank, which include collateral, a business plan, your business financial details, complete financial statements, as well as personal financial details, amongst other things. Bank loans provide large access to capital for entrepreneurs, however, it has a high risk of collateral loss. It is always advisable to call up your local bank to find out more information. Now let's take a look at our fourth option, angel investors. An angel investor is an individual with large amounts of capital who is willing to invest in a business venture, typically in exchange for ownership equity in your company. Angel investors sometimes come together in groups to analyze and scrutinize business proposals in order to select the perfect candidate to invest in. The funds provided by an angel investor may be on a one-time basis to help the business take off, or it could be a continuous injection to support the company through difficulty at its early stages. Besides capital, angel investors often offer mentorship for startups. They are normally willing to take risks for your business idea as they anticipate heavy returns on investment, but overall their main focus is on helping you take your first steps rather than possible profit they may get from your business. An example of a company that started off with the help of an angel investor is Google. There are plenty of investors willing to invest in businesses that are truly promising. Some of these investors come as individuals, some come as corporations. Which brings us to our fifth option, venture capital firms. Venture capital is a form of private equity financing that is provided by venture capital firms. They provide funds to startups and emerging companies during an early stage that have high and long-term growth potential. Venture capital firms consist of professionals that have a keen eye for seeking out companies with great prospects. However, they do not always take a monetary form. They can also provide investment in the form of technical and managerial expertise. They monitor the progress of your company once they have invested and ensure the sustainability and growth of their investment. As an entrepreneur, you tend to lose control of your business since you will be giving up a large part of it to the venture capital firm. It is also worth noting that venture capitalists normally seek for bigger companies with proven profitability, stability, and an identifiable workforce. So if your startup does not have this level of stability, this may be an obstacle for you. Good examples of companies that were funded by venture capitals are Starbucks, Apple, and Intel. The next option on our list is one of the fast-growing methods of startup funding called business incubators. A business incubator is an organization geared towards speeding up the growth of startups and assisting in the development of small businesses in their early stages by providing them with services such as management, training, or office space. Startup business incubators nurture businesses and offer mentorship and resources to help small businesses grow. They also link your startup to other startups to help create connections and networks. Business incubators are a great way for young entrepreneurs to get started. However, it takes a lot of commitment and dedication from both sides in order for your business to really grow. Examples of companies that came out of business incubators are BetaBox and Rhythmio, just to name a few. Last but not least, we'll be shining a light on one of the most competitive ways to raise capital for your business. Startup funding competitions, better known as pitch competitions. These are competitions and contests that allow entrepreneurs to pitch their business ideas or prototypes against other competitors to win funding opportunities. These competitions may be based on a specific niche or industry category. As a contestant, you are required to present a comprehensive and detailed pitch in order to win investment. Pitch competitions normally involve media coverage, so it's always a good way to market your business. Pitch competitions are growing in numbers all around the world, and startups are participating in competitions yearly. Unfortunately, out of a large number of startups taking part, only a select few manage to win funding. It is easy to get demoralized after losing pitch competitions, but the key is perseverance and dedication to your idea. As you can see, there are quite a number of options for funding for your business. The key is to understanding your business, your market, and your targets, and seeing which method better suits your business venture. Perhaps not all these methods will work for you, but now it's up to you to go out there and test what will. And how do you do that? Think hard about your business and at what stage it currently is, and then approach the method that makes sense. And if you'd like to keep learning on your journey ahead, don't forget to click subscribe and share with others. Until next time, always remember to add value and keep moving mountains.